You know what a structured product is? A lot of people don't, and they've become extremely mainstream. This week, we're going to talk about what structured products are, how you can use them, why they've captured market share, and why it's the sort of thing that a lot of people can use to help manage their own behavior as they make better wealth decisions.
This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
My guest this week is Matthew Thomas. He is the Director of Structured Solutions Group over at National Bank Financial, and he holds an MBA in Finance from the University of Monaco. Matthew, how are you today?
I'm well, thank you. Good to see you, John.
I've been looking to have this conversation for a long time because structured notes are the sort of thing that a lot of people aren't familiar with, but they're very important as a tool in the toolbox. And I can't think of anyone who's better to talk about structured notes than yourself. So maybe we can begin by having you provide an overview. What exactly are structured notes?
So structured products are, they're a bit of a hybrid product. They have some characteristics of fixed income as well as some characteristics of equity. Their popularity over the past 10 years has grown in Canada immensely. A multi-billion dollar industry has developed as people look for ways to capture upside of equity markets while also protecting their downside. And I think what's most interesting for a lot of people with structured products is they give you the opportunity to get a defined payout. So, and what I mean by that is like, if you know that if A happens, you're going to get B. And from a behavioral finance point of view, that's a really valuable thing for a lot of investors because uncertainty can cause some sleepless nights.
So you've talked about how you can use structured notes depending on your viewpoint with regard to what the market may or may not do. Can you maybe take a moment to explain how different advisors use different kinds of notes in their practice in order to express a viewpoint for a possible outcome, or perhaps also to protect against a possible outcome?
Sure. Another one of the more appealing elements of structured products is that we're really flexible and we're able to build notes to deliver on different viewpoints. So if you're bullish, we can build an accelerator that sort of builds upon that bullish point of view. If you're looking for protection, but also higher income than you might get from high yield or traditional fixed income, we can build an income note linked to certain types of equity indices to do that as well. If you believe the market is range bound and you'd like to sort of benefit somehow in a range bound sort of market that's flat, we even have something that we can do there. And on top of that, there's a lot of fully principal protected options that we can do that benefit different types of investors, given the certain types of risk they want to take.
So it's interesting because a lot of people don't really realize in financial planning and in capital markets, the idea that is pounded into people is that you should always diversify within and throughout asset classes. And it seems to me that principal protected notes or notes in general, structured products, will allow you to do that. They allow you to have a different kind of exposure, which is separate and distinct from traditional long-only asset classes so that you can have a viewpoint and manage risk, but also hopefully enhance returns or some combination of the two. So the interplay between the way notes can be structured is useful because there's a lot of flexibility. And I'm wondering if you could maybe take a moment to talk about benefits and limitations. What would you say are the maybe 2 or 3 major benefits of structured notes?
First off, the idea of downside protection, you could argue that at times people maybe take too much downside protection, but the ability to say, hey, listen, if the market, has a really rough period, your principal is either fully protected or partially protected. That concept is huge for investors. In my opinion, what really gave rise to this industry is probably the low rate environment that we saw post financial crisis, 2010, 2011. And at that time, there were a lot of advisors that were trying to get their clients into the markets. There were really great opportunities. The markets were low, but there was a lot of resistance and there was a lot of fear. And what structured products enabled at that point in time were to say, hey, listen, let's try to capture some of this upside, and then we're going to protect you down to 30 or 40% or even 100% in some cases. So in that regard, it was a hybrid, or has been and is a hybrid that enables people to sort of have a bit of your cake and eat it too.
And what about on the downside? What would you say are the major drawbacks of using notes?
For me, the primary drawback is probably tax treatment. To some extent, you're taking some degree of equity risk when you build notes, and all notes are taxed as income, regardless of the structure and regardless of the amount of risk you take. They're given the exact same treatment as if they're a bond. For me, that's the primary limitation. Other limitations that are probably worth mentioning, if in certain cases your upside is going to be capped, right? If you buy a certain type of note, yes, as I mentioned before, if A happens, you get B, but you are going to get B, right? You're not going to capture the crazy bull if it gets rolling.
Right.
That's not true for all notes, but it is true for some notes.
Right. And you could just as easily make the point on the positive side is that there is a limitation on how much you can lose. So if you've got, for instance, an inverse note and there is a cap on how much you can lose, even if the market goes way, way up, you only lose a small fraction of that based on the terms and conditions. So it does cut both ways. The benefits are also the liabilities depending on which way things actually go.
Oh, 100%, right? I mean, if you're going short the market and the market goes way up, your losses are, as you know, they're unlimited. But if you do want to take advantage of a market downfall, using an inverse notes is a really, really, I think, responsible way to do it because you're capped at how much you can lose.
Yeah. I think it makes sense for most people that if you're going to use structured products, probably better to do it in a registered account for most people, because that way the tax treatment will be less of a concern because it's in a registered account. What I hate is when you have a person who puts it in a 6-digit ticket for a note and the note does really, really well. But then clients are upset because on the one hand, they've made a lot of money. On the other hand, they got to give up to half to the tax man because it did so well. And so it's almost like you're being punished for doing well with some of these products because of the tax treatment. So you do have to be careful in where you place them, as you pointed out. So I just wanted to reiterate that and put it into context in terms of what accounts to invest in and not just, talk about, well, the tax treatment is potentially negative. Can we talk for a minute about inverse notes? Because certainly in my world, that is the structure that I tend to use the most in my own practice. So just to put it in perspective, inverse notes go up when the market goes down and down when the market goes up. But there is oftentimes a barrier. So even if the market goes up by a lot, you will only lose a small amount. Maybe you could take a moment to explain a little bit more than what I just did about what an inverse note is and how it works.
Sure. Well, I mean, you kind of did my job for me there, but that's exactly what an inverse note does. It captures downside of a particular market in a positive way, right? So if the market goes down 10, you're up 10, down 15, you're up 15. That said, it's got limitations because in most cases, what we do is we build them to create the opportunity to gain from it, but only to a point, right? So if the market does go down by more than a certain amount, you're not going to capture all of it. It's going to stop at a certain point. But the give and take there is that if it does go up, your losses are capped at, say, 5 or 10% in most cases. In fact, most cases, your losses are capped at 5. So in effect, it's an alternative way to do what people think of as shorting the market. It's a safer way to short the market. If you really, really have conviction that the market is going to go down, it's a good way to do it without putting all your eggs in one basket.
Right. And I think it's especially important because in Canada, most financial advisors are not options licensed. So first off, it's probably a more responsible way of shorting the market. But then secondly, the very large majority of financial advisors in Canada are not licensed to sell options. And so if you want to use options, you can't. Most advisors don't have the tools in their toolbox to do that. So this gives them access to additional tools that they otherwise might not have exposure to.
It does. And I think from a top-down point of view, if you look at the management at different dealerships on an investment level, I'd say that, if advisors have conviction that the market is going to go down over a certain period of time, this is a much more preferred device than, either buying puts or going straight short. I'd say that this is more advisable from that perspective.
One of the things we didn't talk about is the lag effect in these notes in terms of their tracking prior to maturity. So it's dollar for dollar in an opposite direction. If the market is up 20, you're down 12. If your market is up 20, you're down, but no more than 5 or 10. But if the market is down 20, you're going to be up 20, but only upon maturity. If it's down 22 months into, say, a 1-year note, you're not going to be up 20. You're only going to be up a fraction of that because the way that the timing works. Can you maybe take a moment to expound on that?
Yeah. And that's just the delta of the product really is. It can be an issue there. If you bought an inverse note, the day before the COVID implosion of the market, you would expect to have done extremely well. And you did okay, actually. You captured some of it, but you didn't capture all of it. The primary reason for that is, as I mentioned before, structured notes are a hybrid product, right? They're backed by the bank as a deposit. That said, to create the payout formula, we do use options, right? So we hedge ourselves using options. We create the payout formula using options. So we've bought options effectively to create your inverse note. So as time goes on, you get closer to your maturity date, the value of your note will better reflect what's actually happening. But the delta isn't perfect at first, that's for sure.
Yeah. So there's always a bit of a lag effect is the way I would
There is a
describe
lag,
it. So that if the market is up, you'll be down, but not by as much. If the market is down, you'll be up, but not by as much.
But
and
not
it doesn't
by as
get
much.
to be dollar for dollar inverse tracking until the maturity date. And so, it catches up and the delta narrows as you get closer to the maturity date. So
Yeah, it gets closer and closer as time goes on. But yeah.
I wanted to have a conversation about prospect theory. And, in my book, Bullshift, and in other things I've written, I talk a lot about how an important element of the industry is that financial advisors are always trying to be behavioral coaches and trying to keep their clients invested for the long run. And that's great in theory, but in practice, a lot of people don't always stick with the program. As the saying goes, the difference between theory and practice is that in theory, there's no difference, but in practice, there is. And one of the things that I find is that inverse notes in particular are useful because when markets are tumbling, not only are clients not going down, but they're actually going up. And that
Making
helps
money,
them
yeah.
to stay the course. Does National Bank ever have any views or state anything, or do you personally have any views with regard to prospect theory and loss aversion and the role of actually helping people understand the psychology of staying invested?
I don't know about bank-wide policy on that, but I can tell you that in the industry I work in, the structured products industry, loss conversion is a key part of the interest we have in our products, right? The truth is that having a hybrid product that gives you some of the protection, but also gives you the possibility to capture upside at the same time is pretty crucial. I think you and I can both agree that loss aversion it's a pretty massive behavioral driver for investors. So if you can create a product that sort of gives them comfort, but also gives them the opportunity to participate in markets in whichever direction, I think it's important that we not discount how people feel about what they invest in. I think it matters more than people think. Some people will claim, investors are irrational. They shouldn't buy this. They shouldn't do that. But humans are irrational. So an inverse note allows you to get a certain type of exposure in a safe way. And in doing that, you're doing something that I think is actually important for investors, which is keeping them invested. Because I think too often when we have difficult market periods, when we hear about tariffs, when we hear about everything seems like a catastrophe. But if you actually follow an index chart over time, markets go up. And keeping people in the market, I think, is crucial. And I think the structured notes do a lot to make that happen for some people.
I obviously agree. And the reason, again, why I was so eager to have this conversation with you eventually was that I wanted to have the conversation at a time when people were feeling some consternation. And as we're recording this on election day in Canada, and it'll be posted a few days later. And so there is an uncertainty as to what will happen in the Canadian election, but there's also uncertainty as to what will happen when the reprieve on the current 90-day tariff hold of Trump is lifted. And there's a whole bunch of different things that people just don't know, and you have to hedge the uncertainty. And I just find that being able to have a tool that allows you to hedge your risks and offer some diversification is actually comforting for many, many people. For the people who use structured notes, what percent of a client's portfolio is usually allocated to notes for those people who use notes?
So it really, really varies. I know portfolio managers that have 30 to 40% in structured notes. So in doing so, that's obviously not all sort of RSP money. So they obviously believe in the strategy. I know other advisors that allocate 10 to 15%. In most cases, what they're doing is very strategic. So the advisors that are using it for big chunks, in most cases, what I see is that they're really, really supplementing income. They're probably replacing what would have been fixed income 15 years ago. They're probably using different types of structured notes to cover that, whether it be income notes or principal protected notes. There are a number of other IAs that are looking to really, really capture upside using structured notes. They buy things like auto-callable notes and accelerators and boosters, but it's very, very tactical how they do it. And they say, I'm going to do this much in a portfolio. And they sort of follow that on an annual basis.
And it's funny because what you just said about income got me thinking about what we said 10 minutes ago, that if in fact the notes are playing an income role, then the tax treatment is no different from what it would be as if you were holding bonds. I guess the caveat that we used 10 minutes ago is that if you're using a note as a supplement to your equity portion, your equity sleeve of your portfolio, you need to recognize that it'll be taxed less advantageously. But if you're using notes as a replacement for income, the tax treatment is the same, and you should be indifferent to whether you use a note or a bond, because it'll be taxed the same way at the end of the day anyway. As long as the performance is superior, you should be happy.
Yeah, that's totally true. The notes are linked to equities, so there might be some disagreement on whether or not they are a fixed income alternative or not. But I certainly see why people would use them that way. That's for sure.
Let's wrap this up, Matt. I always like to talk about wealth decisions. And one of the great ways that structured products are useful is that they can give you a lot of latitude in the decision making you make and how you construct portfolios and how you think about the way the world is evolving. If it was up to you, what advice would you give to people to help them make better wealth decisions?
Stay invested. That's my advice. The truth is that markets go up. They go up and, things revert to the mean. Stay invested. And I generally believe people will do extremely well.
Thanks so much for your time this week.
Yeah, no problem. Thank you.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.